Hey guys, welcome to another week. I am so glad to be here with you tonight. We went out to dinner, and it's in Alabama, so you know it's going to be some good home cooked food. And I know there was a lot of discussion on Russ's channel last night about Cracker Barrel. We did not go to Cracker Barrel, but it was very similar in terms of the food. It was a what they call a meat and three. I don't know if you guys have ever heard of that before. You get basically some meat, and you can decide what that is. They've got a list of them. It can be meatloaf or chicken fried steak or chicken or whatever, and then you can pick three different vegetables go with it. So I had a good dinner, so I was really glad about that. So tonight we've got a pretty controversial topic. I mean, I've heard a lot of my friends talking about SCHD, and I do not own SCHD. So I thought it would be good for me to share with you guys why I don't own it. Now, going into this, don't take this the wrong way. Me not owning SCHD is not trying to tell you that you should not own SCHD, right? Because each of us are the chief investment officers of our own portfolio. So as the chief investment officer, we have to make some tough decisions. And, if you've decided that SCHD fits in your portfolio, I'm fine with that. I'm not mad about that. You get to make those decisions. That's your decision, not mine. But I get to make the decisions for mine. And I thought it would be worthwhile for you to at least hear the why from, me, why my portfolio does not have SCHD. So, there's nothing wrong with gathering more information, right? So with that, hey, I'm going to go ahead and kick this off and get this train rolling. So here we go. Why I do not own shares, and that probably should say of SCHD instead of in SCHD, but hey, it's okay, whatever. And I will say this, that due diligence applies as much to ETFs as it does individual stocks. So you want to look at the prospectus. You want to understand how they select their stocks, what they're trying to achieve by selecting those stocks, and determine whether or not that meets your criteria for your portfolio. So I just wanted to pass that public service announcement along to you. And I know my buddy Russ is in the program tonight. I'm glad to see you're here. And you took a shot at me last night about spending 15 minutes on individual stocks. But, I got to thinking about that. And it's probably true. But, what you get when you get to this program is it's not about entertainment. And it's not about me telling you what stocks to buy. It's about walking through the process of learning how to look at stocks, how to make a valuation, how to make a call. And sometimes it takes a little time to do that. So, there's a lot of channels you can go to for entertainment. There's a lot of channels you can go to where they will say, you need to buy these 5 stocks. But you probably, unless I've been drinking, you probably will never hear me tell you, you need to buy these 5 stocks. And why is that? It's because I don't know your portfolio. I don't know your age. I don't know your desires. I don't know where you're wanting to go in life. So for me to tell you, you have to own these shares in these stocks, it's just not the right thing to do. So I won't do that, and I don't do that. I will tell you what I'm buying, and if you want to, follow along with that, then so be it. But you get to make that call. I don't make that call. So with that, let's go ahead and get started. Criteria for SCHD holdings. So the first thing we want to find out is, what do they use? What criteria is used by SCHD to determine what its holdings are? So let's kind of walk through some of that. First of all, their purpose says to pursue its goal, the fund generally invests in stocks that are included in the Dow Jones US Dividend 100. So there's basically 100 stocks in this Dow Jones US Dividend 100. So how do they get the criteria for that? How does the Dow Jones US Dividend 100 get that criteria? Their first criteria says it's got to be a minimum of 10 consecutive years that they've had dividend payments. So check. I mean, my criteria is only 5 years, so that's not too bad. Then a minimum float adjusted market cap is 500 million. So that's fine. And then a minimum 3-month average daily traded value of $2 million. So basically they're saying, we want a company who has a long track record of paying dividends, who has decent size, and who has liquidity in the market. That's basically what they're saying. And, that should actually produce quite a few stocks. So then, so with that, what happens? Well, then the stocks that meet this criteria are ranked in descending IAD yield. Now, IAD stands for indicative annual dividend. And so that's basically the forward dividend. It is the dividend that the company is indicating that they are going to pay. And they do that, I guess, for legal reasons. But anyway, it's the IAD yield. The top 50% of this list is used and eligible to be bought into the index. And that would also apply for SCHD. So that means that the bottom 50% are tossed out and never to be seen again. So they've got, then after that, they take 4 criteria. Now, these criteria are not in order. They are basically weighted equally. Each of them has a 25% weighting. Sorry to get so nerdy, but it is what we do when we do due diligence, right? The free cash flow to total debt is 1. The return on equity is 2. The IAD yield, that forward yield, is 3. And a 5-year trailing dividend CAGR is number 4. So let's kind of unpack this. What does all this mean? Well, first of all, the primary criteria for SCHD is high dividend yield. So that's got to tell us something, right? It means that they are looking for stocks that have a high dividend yield. It's in the title. HD stands for high dividend. So, they're not trying to hide that. That's what they do. And so we just need to understand that. Secondly, the ranking criteria for the top 50% high yielders are equally weighted. So we have the free cash flow to total debt, which protects the fund from poorly financed companies. So if a company has tons of debt, low cash flow, they're going to kind of settle out in many cases to the bottom. The return on equity is lacking since it can easily be manipulated by stock buybacks. What do I mean by that? When a company buys back shares, they will pay cash into the market to buy those shares. They'll buy those shares, bring them into the company. So they basically credited their cash account. They then have to debit something, right? Because accounting has always got a balance. That's why they call it a balance sheet, right? So when that comes, the debit side to that credit is equity. So how do you improve your return on equity without improving your return? You reduce equity, and you do that by buying back shares. So companies that buy back a lot of shares are able to easily manipulate their return on equity. So that's one of the issues that I have. Then the third one is the IAD yield, and it usually is a high yield for a business reason. There are companies out there with high yield, and we need to understand as investors what that reason is. That why are people needing a high dividend in order to invest in that? That means that there's some risk there that maybe we don't know about. Next, we have a 5-year CAGR, dividend CAGR. That's the cumulative annual growth rate. It can be, you can grow the dividend as a company. You can grow the dividend through debt rather than business performance. And so we want to be able to measure that. So here's the thing for me, for SCHD, I see 3 criteria here that require judgment from an investor. I can't just take those 4 criteria, weight them evenly, and then pick the top stocks that come out of that, because 3 of the 4 of those require judgment. And as an investor, as somebody who loves to do due diligence, I don't want to put those 3 criteria, or the 4, I guess, total, in someone else's hands to make the decision for me. I want to make that decision. So here's another reason. The SCHD total return performance has not been that stellar. You look at, this is something that I put out weekly to my inspiration and collaboration tiers. but it basically takes the Wealth Circuit investing portfolio, my portfolio, and it compares it to three things. It compares it to the Vanguard S&P 500, the DGRO, which is the dividend growth, the iShares dividend growth ETF, as well as the Schwab US dividend equity ETF, which is SCHD. So when I look at the performance for 1 week, you can see that SCHD is actually in third place. So the dark green would be first place, light green second place, light red or maybe pink is third place, and the darker red is fourth place. So for 1 week, you can see how everything shook out here. SCHD was in third place in these portfolios. And if it's close, there would be a white here, but this would be really light green. You just can't see it. So in the 1 month figures, SCHD is also in third place, actually beating out DGRO. When you get into the longer years, though, not too far out, but longer years, 3 months, SCHD is in last place at 4.12%. We then have year to date, which is pretty similar to the 3 months at this point because it's March the 22nd. So, give it another week and these will be exactly the same. So 3.19%, last place again for the 1 year. And these are all total returns pulled out of Morningstar. I keep my portfolio in Morningstar, so it calculates for me my portfolio's total return as well as, all of these other indices. So when I look at the 1 year, SCHD's in last place again, 14.86%. I will say that's not bad, right? I mean, wouldn't we all want 14.86% per year? But, at the end of the day, it's just lacking. It's falling behind all of the other metrics. And then in the 3 year, you'll see that my portfolio is NA there. My portfolio, this Wealth Circuit investing portfolio, has not been in existence in its current form for 3 years yet. I got another 6 months to go, and then I'll start putting a 3 year out there. But so I put an NA in there for now, and then but you'll see that SCHD is also lagging behind on the 3 year. My memory says that SCHD, when you get out to like a 10 year, is more competitive, but it's back from 10 years ago, and I just don't see it in the current portfolio. So, all right, why do I not invest in SCHD? Here you go. Boil it all down. Its criteria can doesn't mean that it always does, but it can ignore business fundamentals. Its criteria can ignore business strategy. So it's looking at numbers and it's not looking at the strategy of the business. Its criteria can ignore management capability. It's not looking at that. It's looking at the numbers. Its criteria can ignore the fundamental reason for a company's high yield. And we know there are companies out there that have high dividend yields, and they have those yields for a reasons. And as an investor, I want to know what those reasons are, and before I decide to invest in a company. Its recent performance has lagged other indices. We've seen that. So just a little fun fact, the Wealth Circuit investing portfolio, year to date, it's just been a great quarter, man. We're up about 7% on a money weighted basis, which is a little different than what you saw on the other slide because that is a time weighted basis. But anyway, money weighted basis, we're up about 7%, which is a little over $100,000 in this quarter. So that is fantastic. But I want to show you this. About 7.5% of that return is from dividends. The other 92.5% is from capital gains. So if we are, especially if you are younger and you are looking to build a lot of high yield dividend in your portfolio, you might be missing out on some capital gains if the market is moving in the right direction. Now, on the flip side of that, if the market is in a bear market and you're fallen and the market's fallen, it could actually be a good thing for you. So the point is, don't miss the business fundamentals by focusing too closely only on the dividends. So here's another thought I would pass out to you. Why would someone invest in SCHD? First of all, I think it's people who are seeking a higher current income, less capital appreciation. That's perfectly fine. And these people also want diversification, but maybe don't like the idea of performing due diligence, for a bunch of stocks. It's just not their gig. And so for those reasons, I think it's perfectly fine to invest in SCHD. So maybe there's some other reasons that people invest in SCHD. Share with me some comments about that. I know some of you hold SCHD, and maybe there's other reasons I just haven't thought of, and maybe we can talk about that a little bit. So with that, I'm going to now turn over to the comments here. Let's see who all's here. Sorry, I didn't mean to ramble on for 15 minutes on that, but hey, it was fun for me. So we've got Pat. He says, can't wait to hear why you don't have SCHD. Pat, I'm glad you're here. I'm glad you're home. And hopefully it's warmed up a little bit up in the north there where you are. And I know it's not as warm as where you were, but hopefully you've got some good internet speed now. And we're glad to have you back, man. Oh, yeah. John Jay's in the house. He says, say it ain't so. Let's see. Suzuki Man 89 says he doesn't own SCHD either. So at least I've got one friend after this live broadcast left. I'm probably going to lose a lot of friends after this one. But let's see. Yeah, he says we're part of the non-SCHD club. And Michael says he's got 1,100 shares of SCHD. So that's a lot. That's a lot of shares. I'm not sure what Michael's total portfolio is, but Michael, throw me some comments out there about why you love SCHD. I'd love to have that discussion. Kevin Rayberg is in the house. He slipped in quietly, but I wouldn't let him slip in quietly. So my buddy Russ is in the house, and he says that it's probably because I don't want to own Ford. That could be as well. Let's see. Kevin says he already holds 7% of the ETF holdings in UPS and Bristol Myers. So there you go. That, I guess 2 of the top 10 holdings in SCHD. One of them is UPS and one is Bristol Myers. One other criteria I didn't add here is that if SCHD has something that goes above 4%, they rebalance that at their next opportunity. So they try to have no more than 4% inside the ETF, but it doesn't always work if you get something that bumps up. So let's see. Pat says he has 348. He's hoping to have 500 by the end of the year. That's great. OJ's in the house. Hey, Kevin, nice to see you. Nice to see you too, my friend. I am glad you're here. Oh, we got Greg in the house. What's up, my friend? All right. So let's see. You guys can throw blows and sell your beef at the Kentucky-Tennessee state line. There you go. We'll meet at the Mason-Dixon line. No, it's okay. You can invest in whatever you want to, my friend. That's no skin off my back. Jacob Harrison's in the house. If I wasn't so poor, I'd buy multiple shares of SCHD, but at the moment, I could only buy 1 share. Hey, my friend, you got to start somewhere. And that's something that we miss as investors sometimes is, sometimes you just got to start. You just got to get started somewhere. And then it will amaze you, just to be an encouragement, it will amaze you how quickly your portfolio is going to grow. Because over time, hopefully you're going to make more money at some point, as you get, raises or you get a promotion or whatever. But then your shares are going to start providing money and you're going to be making more money. And then you're going to decide, hey, I don't want to buy this particular thing because I want to put money in the market. So you're actually going to grow a portfolio a lot faster than you think. Yeah, my buddy Russ always says it very well. 1 share is superior to 0 shares. That is exactly right. Hey, we got El Dynamico in the house. How you doing, my friend? It's good to talk to you the other night. Let's see. Let's see here. Got to start somewhere. Yeah, I'm just trying to find some good comments here that's not just you guys talking to each other, which is great. I love that. Uh, SCHD. This is my friend Shaping. So it's good to have you in the house, my friend. Shaping is detached from the Mag 7, which lead a lot of the recent gains in the S&P and QQQ. That is absolutely right. The Mag. So when you look at that VU return, and you saw how big that VU return was, a lot of that came from the Magnificent Seven. Another thing that I track that I really don't share with anybody is I've put a portfolio, a fake portfolio together in Morningstar that is just the Magnificent Seven, and it tells me what their return is. Then I mathematically calculate what the remaining 493 to 497, because I think there's 503 or something like that, stocks in the S&P 500 were. And it's really, it's kind of fun to track that. It doesn't mean anything, but it is fun to track. So El Dynamico, good question, my friend. But isn't strategy reflected on the numbers themselves at the end of the day? And I would say it depends. And because the numbers that they're looking at, especially the like the dividend, the 10-year history of dividend, the numbers that they're looking at, the compound annual growth rate of the stock dividends, all of that is historical, and they're looking at the forward dividend yield, but that's based off of what the company has said so far, which is basically their current dividend. It does not give any credence to whether that company can continue paying that dividend or not. Does that make sense? So it's not about the strategy. It's not about the things that could happen to impact that company's dividend in the future. It is about the numbers. It doesn't appear to be, unless there's something behind the scenes, and that very well could be. They don't call and ask me, right? But I don't see anywhere where it says we have this process where we analyze every company, and in addition to these numbers, we look at these intangible criteria and make decisions off that. I just haven't seen that. So anyway, those are my thoughts, El Dynamico. It is certainly the numbers mean something, but from my perspective, having been inside the numbers for my whole career, I understand that there are ways to manipulate those numbers. Return on equity is a good example. So just makes me a little nervous. I don't know. So Greg says, curious to know what holding were SCHDs 10 years ago when it beat the S&P. Yeah, I would agree. Maybe I don't know if I can find that or not. I'm not sure I could even find last year's holdings, but I could try to find out what those were. But I think it too had to do with the market itself. There was a big run up in the market, starting, I guess, in 2015, 16 timeframe. So maybe it could have been just that. It may not have been the particular stocks, but maybe we can do some research on that. That's a great question. Russ, my friend, says Peter Lynch would be displeased with SCHD cutting the flowers, which are Broadcom and Williams Sonoma. I think that's WSM, and watering the weeds, which is Ford. But it's the ETFs methodology you're ultimately buying. And I think that's very well said, Russ. I think that's exactly kind of where my heartburn lies, is that it throws away the stocks that I think have some great potential. So, watering the flower, cutting the flowers is a good way to put it. Michael Swami, great to see you here, my friend. Quantitative approach I can understand, therefore I own it. Okay, well, very good. I appreciate that. So it's the understandability of the criteria, and I certainly get that. Let's see. What else do we have here that's good? My buddy El Dynamico says it's good to talk to real people once in a while. Yeah, I am certainly not fake, my friend. I am real, and what you see here is what you get. Even if you see me and talk to me on the phone, or see me out in the public or whatever. John Jay, how do I feel about VYM? Let me come back to that. I'm going to write that down. We'll come back to that after I kind of get through and see who all's here. So VYM. So this is from Pat. Okay, Kevin, you don't have SCHD. So what is your favorite high yield ETF? Well, I don't have one. I don't. I do like DGRO. It's not a high yield. It is more of a dividend growth play. But hey, let's do this real quick. Just for fun. Are you guys ready to have some fun? Okay, I'm going to share this screen with you guys just so that we can have a little bit of fun here. I'm going to take Pat's comment off so you can see. I don't want to look at Seeking Alpha. I want to look at Simply Safe Dividends. This will be a little bit of fun, okay? I got to get my cursor in the right spot here. There we go. All right. So let's look up SCHD. And we find that SCHD has a current dividend yield of 3.37%. I don't consider that a high dividend yield, but you know, it's neither here nor there. So 3.37%. Its dividend growth is around 4%. So if I were to say, hey, I'm expecting about let's say give them 3.5%. I'm expecting 3.5% in dividend yield, and I'm expecting 4% in dividend growth. So maybe I'm looking for about and if that dividend growth is coming from the stock performance, then I'm looking at about a 7.5% yield or gain, I guess, every year. Now let's look at DGRO. All right, so you guys ready for this? So 3.37, remember that, dividend yield, and 4% dividend growth. So now you're seeing that DGRO is 2.32, not terribly different, 1% lower, or they would call that 100 bips in the business, basis points. And but it's got a 13% dividend growth. It's and so you see where I'm going with this is that there's, it's about a third less in dividend yield, but man, going from 4% growth to 13% growth, that's a pretty big deal to me. And then let's look up VU. Which is 1.34% versus a 7% growth. So I like DGRO better than I like VU, although VU is what I have. It's my highest holding in terms of ETFs. Actually, it's my highest individual holding overall. Let's look at VYM for John here. VYM is Vanguard's high dividend ETF. They are at a 2.87% yield, which is less than SCHD, but they have a 7% growth, which is more than SCHD. So if you put that together, they're both about the same. But the VYM has a higher growth trajectory, whereas SCHD has higher current income. So that would be my thoughts on that. I don't know. So Pat, I don't know. To answer your question, my friend, I don't know that I have. Whoops, I don't want to kick myself out. Let's do this. Okay, there we go. I don't know that I have a high yield dividend ETF that I think is my favorite. I like to kind of do my own, and that's probably part of this as well. Is that I do enjoy this research. I do enjoy due diligence. And so if I'm going to enjoy that, why not just do it? Why not, instead of paying SCHD their management fee, why don't I just do it and keep that fee myself? So that's kind of the way I look at it. All right, ex-dividend dad is in the house. I don't remember your saying, but usually you come in with X to the who, X to the what, ex-dividend dad's in the house. So anyway, welcome, my friend. VYM, this is Dresh. Hey, Dresh, great to see you, buddy. VYM just had a year-over-year dividend increase. That's great. It's great to hear. And then they've got about what that said about a 7% dividend growth rate. So I would certainly expect them to have something there. So Corman Vax, my friend, I don't know that we've ever met. It's great to have you in the program tonight. Welcome, my friend. SCHD is 5% of my total. I'm still happy to own it within all my ETFs. I learned a lot from you, Kevin. Thanks. Hey, thank you, my friend. I'm glad you're here. And this is what this channel is about. It's about us learning together, because sometimes I actually learn stuff as I'm putting the notes together for this program. So you guys help me a lot, and hopefully this is helpful to you guys as well. Oh wow, we got Mr. Income Fenders 53 is in the house. Welcome, my friend. Let's see. Ex-Dividend Dad says he stopped buying SCHD and is focusing more on DGRO. And I think, if you are younger, that makes a ton of sense to me. If you are older, you like me, or, maybe some of my older friends, I don't consider myself that old. I still think I'm 33, but I'm certainly not 33 now. And you'll get that way. You'll understand what I'm talking about when you're older. So when you're older and you think back to this conversation and you go, wow, I still think I'm 33, you'll know what I'm talking about. But he also says he's not selling SCHD because it's his biggest holding. So there you go. There's that. Fast Eddie's in the house. Welcome, my friend. Tutomi is here. Welcome to the program. Let's see. Okay, here's a good question. My friend Jacob says, honestly, how do dividend payments even work? And let's chat about that for a second. So, and for that, I think I'm going to need a drink. I don't know what you guys are drinking, but I'm drinking water with a little bit of that Mio that you squirt in there. So I find it to be tasty, especially the lemon. Swallowed that the wrong way. Shouldn't have done that. Okay. So how do dividend payments even work? So let's start, first of all, with the company. The board of directors decides what a company is willing to pay for its quarterly dividend. Let's assume it's quarterly for the moment. So they will, sorry about that, guys. They will decide what the company can pay. The company will then make the announcement that they will pay the dividend with an ex-dividend date of a certain date. And if you own the shares on that date, you do not get the dividend. And if you owned it before, you do. Then they have a pay date for that dividend, and that's when they actually will send out the payment. They'll do it through the brokerage, so your brokerage will actually put that money into your account. They will, for the company, it's basically a cash payment, and it's recorded as a dividend on the books. So, and it goes against the equity of the company. And that's why you will see, this might be getting into too much information, but that's why you'll see when the ex-dividend date hits for a company, its share price will usually drop by the amount of the dividend. It's because they're paying that out in cash. So that's how it would work on the company going into your brokerage account. I think maybe you're talking about how it would work through SCHD. So SCHD or any ETF would have a list of companies, and then each of those companies would pay part of their dividends to SCHD. SCHD would then put those in a bucket and then pay those out to the shareholders of SCHD, because everybody owns a little slice of that pie. So hopefully that's helpful. I don't know if I want to go into too much more detail than that, but because it just gets complicated, right? Let's see here, my friends. What do we got? Suzuki Man says he holds VIG and VYM in separate portfolios. So that's great to hear. What's HDV on your website? Is that better than SCHD and VYM? HDV. I don't have a website, so I'm not sure. Maybe he's talking about somebody else. But hey, let's look it up. I'm not sure what HDV is. So we will swing back over this direction just to see what it is, because I am at a loss. That's the iShares Core High Dividend ETF. And if you look at that, it's really pretty close to SCHD. I don't know, looking at this, what the management fee is, what the expense ratio is. So you would want to check that out. But it is 3.41% dividend yield versus a 5% dividend growth. So they're all pretty close, in my opinion. You'd want to look for one with a lower fee probably. Okay, so let's go to here. And welcome to the program, Kenji. I don't think I have mentioned you yet. So John J says, great analysis. VYM is partly for growth and then income too, also like VIG and VUG. That's great. And then John's also talking about VYMI, which I think is the international version. And that's great. If you want to have international exposure in your portfolio, I think that's fantastic. The way I look at it is I invest in U.S. companies that have international exposure. So I'm getting my international exposure within the holdings that I have. I'm not saying that's the right way to do it. I'm just saying that's the way I do it. So you guys can take that with a grain of salt, but that's what I do. All right. So what do we have here? Joe Zamora, welcome, my friend. Joe says SCHD is his largest holding. He's now building up his FDVV and DGRO. So FDVV, I believe, is the Fidelity High Growth Dividend ETF, and DGRO we've talked about. FDVV actually looks really good to me. I was using DGRO and FDVV and comparing them for quite a while before I finally ended up with DGRO. But I tell you what, they were so close. I think it was the expense ratio that caused me to lean toward DGRO. But FDVV has had some really good performance, and so that's a good call, my friend. So Shaping says he's 19. He owns no SCHD or any stocks that yield over 3%, except this one REIT that he owns. Yeah, REITs typically will have a higher dividend yield. So I think you're right, Shaping. I think that's the way for a 19-year-old to look at it. I think over time, your growth is going to be what takes you to the promised land, so to speak, the land of milk and honey. All right, Jim Betts, welcome to the program, my friend. Don't own any SCHD either. Having an ETF is easier, but I find due diligence kind of fun. So maybe we are brothers from a different mother. Keeps my mind busy and keeps my brain from turning into Play-Doh. Well, yeah, what I say, Jim, is it keeps me out of trouble because my brain can get myself into trouble very fast. So I don't blame you on that at all. Jacob, Kevin using layman's terms is why I love attending his class. and that's kind of, Jacob, what this is. It's kind of like a class, right? It's some people are turned off by that, and that's okay, because I don't want to be anything that I'm not, right? I love to share. I love to share what I've learned, and if it helps you, that is fantastic. So that's what I'm about. Let's see. Tutomi here says, hey, Kevin, you will consider buying SCHD if the price is $50 or less. No, actually, I wouldn't. The price doesn't matter to me at all of what SCHD is. And you say, why is that? Why doesn't the price matter? Why that doesn't matter to me is that the $50 price is based on the holdings within SCHD. So if the holdings within SCHD have gone down so much that the price of SCHD is $50, then it's because the holdings are down. And so SCHD or any ETF for that matter, or any mutual fund for that matter, doesn't make a dime. It gets its fee from you, the investor. You pay them an expense fee. They don't make anything. They're only value comes from the shares of stocks that it holds inside of it. Hopefully that makes sense. So if the share price of SCHD goes down, what that means is in total, the holdings within SCHD are worth less than they were the previous day. So no, you were probably joking, but you got me all spun up there too, Tommy. Can't believe you did that. Okay, El Dynamico holds SCHD, JEPQ, and Devo, the triple threat. That sounds like a triple threat, my friend. Let's see. Okay. Yeah, you guys are chatting, which is great. Most of my this is shaping. Most of my portfolio is in the stock that have very low yields and payout ratios, but high dividend growth rates. I think that's fantastic. So, yeah, I'll let that go for a while. Let's see, Miguel. Welcome, Miguel. I haven't seen you here tonight yet. In your opinion, it's better to buy a stock with voting rights or not? For example, I want to buy the Brown-Forman stock, but I don't know if I should buy with voting rights or not. So great question. And I don't know that I've ever heard anyone ask that question. And so for those of you who don't really understand what he's asking, there are companies out there, and Google is one of them, or Alphabet is one of them, that has two tickers. One ticker would be GOOG, and one is GOOGL, I think is the second one. And the one with the 4 letters has no voting rights, and the one with the 5 letters has voting rights. So what does that mean? That means that you get to vote. If you have the one with voting rights, you get to vote at the shareholder meetings and things like that. From my perspective, I look at both of them as kind of the same, because I'm not going to own enough shares to really drive anything inside the voting of a company, right? So I don't really get worried about that. I will look for the cheaper one. And if I can find the non-voting rights cheaper than the voting rights, I'll pick that one up. And so I don't get too bent out of shape either way on that, Miguel. I didn't realize Brown-Forman did that, but I do know that Google does that. Google does that. So let's see. Robin, thanks for joining us, Robin. It's good to see you. Thanks for the video. I own SCHD and DGRO, and I think that's a great combination. If you're looking for both some higher yield and some higher growth, I think that combination works very well. All right. Tutomi says, thanks for the great explanation. Well, you are welcome, my friend. All right. Okay. ETFs trade. Oh, and let me share this. I thought Tutomi was kind of joking, but he says he was not joking at all. It makes total sense. So I appreciate you saying that, and I'm glad I actually answered it. So let's see. ETFs trade at net asset value. Oh, yeah, net asset value. So ETFs can't be manipulated by shorts or whatever. So let's chat about that for a minute. So yes, you are correct that they trade at net asset value. But the question is, what is net asset value? That net asset value is the value of the underlying assets. So if a stock is shorted and it drives the price of that stock down, then it will reflect in the net asset value. You're right that they can't short maybe the ETF, but the holdings within the ETF can be shorted. So just wanted to point that little nuance out. And then also, you might have the question, how do ETFs, if they are a combination of all the holdings, how do they have a price for the ETF and then a price for all the individual holdings? And what happens when the individual holdings get out of line with the cost of the ETF? So hopefully that makes sense. So if people are buying the ETF, but not the shares, and the shares go down in price and the ETF is going up in price, right? How does that work? And there are people who are playing arbitrage in the market, and their main goal is to find those opportunities and take advantage of them. And they happen so fast that individual investors like me couldn't keep up with it. So anyway, you didn't ask that question, and I don't know that anybody cares about that question. But if you did, that's the answer, at least the one that I have. Let's see. Jim says lots of great sub 3% holdings in my portfolio. Walmart, that's good. John Deere, Lowe's, Qualcomm, General Dynamics, and I think UNP is Union Pacific Railroad. So yeah, that's a good point, Jim. Don't get hung up on the dividend yield, especially at 19. I think you're going to want to grow that portfolio, my friend. So yeah, well said. Let's see. My friend Russ is back. Unless you own a massive amount of shares, for us retail investors, the voting is pretty irrelevant. I think that's well said. It's a lot. You said it a lot faster than I did, Russ, but that's kind of where I was going with it. Let's see here. What do we have? Edwin. You know, my dad's middle name was Edwin. So welcome to the program, man. And I love the banner. I just don't know what that is. Oh, it's a Bitcoin kind of thing. Fantastic. So love the content. Keep up the great work. Cheers. Hey, thank you, my friend. Thanks for joining. Because without you guys, what would I have to talk about, or who would I have to talk to? So I really appreciate you guys being here. All right, let's see. Jim, thanks for explaining Goog and Google. I got some free Google when I opened my Sophie account. That explains both holdings in that portfolio. Yeah, absolutely. They are parts of the company, and they are just different shares. They have different voting rights is all that is. All right, let's see. Okay, ex-dividend dad. Can you tell me what you think of DGX? So we have just a few minutes left here. So my friend, let's go over. Let me pull this back up, and I'm going to take your comment away and look up DGX, because I'm not even sure what that is. Quest Diagnostics. So, Quest Diagnostics, it's a healthcare company. They have and so this is kind of raw, right? I don't really know anything about them. So we'll just kind of walk through, and this would be how I would walk through it. It has a dividend yield of 2.3%, dividend growth of 5.6%. They've actually had an upgrade. Well, that was back in 2020. So they've got a dividend safety score of 80, which is not too bad. Look at that dividend growth, man. That looks pretty good to me, like 7% over a 5-year period. They've got a dividend growth streak going at 13 years. So that's fantastic, with an uninterrupted dividend streak of 20 years. So let's take a look at some of their financial numbers here. The earnings payout ratio is around, it's 30s, in the 30% range. Cash flow ratio looks good. Earnings per share, they took a big dip in 22, 23. I would probably want to understand what that is. They are buying back shares, so that's good. They're I meant to say this earlier with SCHD using return on equity. My preference is return on invested capital, because return on invested capital is much harder to manipulate than return on equity. So that's why I look at this return on invested capital inside of Simply Safe Dividends. It's about 11%. That's not lighting the world on fire, but it's certainly not terrible. It's certainly above their cost of capital for sure. Net debt to capital is 43%, and they're pretty close on their interest coverage. So I guess, it is interesting, ex-dividend dad. So Let me come back to here. It's interesting. I would want to look further into kind of what their strategy is, what market they're trying to attain, what their product is. What do I see in the future? So let me. I don't know if that's helpful or not. It's not something that I would jump into, mainly because of the return on invested capital and their debt load, their interest cost looks to be a little bit high compared to what they're earning at this particular point. All right, I'm gonna keep. I'm not gonna go there. Let's see. Tutomi says your chickens are not listening anymore when you talk to them about stocks. LOL. No, that is right. They have tuned me out. And so Dresh wants to know, dude, did I ever get chickens to pick a stock? I am working on that. My friend Jim Betts has given me some great ideas about how to get 12 chickens who have a mind of their own to poop in a place that helps me determine randomly how to pick a stock from where they lay their stuff. So we're working through that. It's a little more difficult than I thought. It seems like it'd be easy, but it'd be easy for me to kind of lay out, hey, here's 10 stocks, but it'd be 10 stocks that I'm picking and they're just picking one of the 10, right? I want them to be able to pick from a giant field, pardon the pun, of stocks. Yeah. Imagine chickens picking Tyson. That would be kind of funny. I don't know, my friend. We'll see. But yeah, we are definitely working on that for sure. Okay, Fenders 53. In my opinion, a dividend ETF is much better than poorly researched port of individual stocks. Both is probably the best answer for many. So yeah, I think that's right. I think if you're not interested in doing the due diligence and stuff, an ETF is the way to go. And if you're not interested in doing it, then maybe maybe don't try, because you may end up in a bad spot. So Shaping asks, is return on invested capital the same as return on capital employed? And the answer is they are very similar. They're not exactly the same. I won't go through the calculations of each, but return on capital employed, if that's what I have, if that return on capital employed is what is calculated, I don't try to calculate return on invested capital because they are that similar. So that's what I would use. If you can get ROCE, that's what I would use. If you can get ROIC, that's what I would use. So I think both of them they're so similar, it's not worth talking about the differences, in my opinion. All right. You might have something there with ex-dividend dad. I'm not sure what that is, my friend. Okay, let's see here. Jim says, I'm glad I was able to help with the chicken things. Good to see my liberal arts education didn't go to waste. That's a great point, Jim. And, we're probably very similar, because I have my undergrad is a liberal arts education. It's I got in the liberal arts arena. I couldn't get a degree in accounting because that was a trade. I had to get a degree in economics and business, and then I could add accounting courses. So I have I had a degree in economics and business with an emphasis in accounting. So, and now I look back on it and I go, wow, I really am glad I did that, because if I had just gone after accounting, I might not have understood the economics around businesses. I would just be looking at debits and credits, and who wants to do that? What kind of life is that? So anyway, yeah, glad you got that liberal arts education, my friend. So is there anything else you guys want to talk about before we get off of this? Oh, this is a good question. Tommy wants to know, what was my first stock that I ever bought? And so that's a great question, and I'm happy to share the answer with you. It was, should I tell the year? Sure, why not? 1987. And I know most of you guys weren't even alive in 1987. My first stock, actually, I bought two on the same day. And back then, for those of you who are younger, like, shaping, there was no internet, right? So I actually had to go down to a brokerage. It was Merrill Lynch at the time. Go to a brokerage and set up an account with a broker, and then actually hand them money. They would put the money in my account, and then I would call that broker and say, I want to buy X company with, and so many shares or whatever. So there are two companies that I bought that day, and one of them was a company called Telcom, which is no longer in existence. It has gone bankrupt. Actually, many years ago, in the 1990s, it went bankrupt. So probably 10 years later, it went bankrupt. And then I bought AT&T. Now, one of the things that I learned in life is that I should have left that alone. So even having bought some AT&T and some of this company that went out of business, if I just left that alone, there's no telling how much it would be worth today, because AT&T back in the 80s grew quite a bit. I know it's been struggling, of late, but there's been a lot of growth. So if I had not sold that, because it was making money, right? So if I had not sold that, no telling how much money it would be worth today. So those were my two first stocks. They were bought on the same day. So I appreciate you asking. So nobody really wants to know about the old days so much. So ex-dividend dad says that he was 1 year old. So you were just still in diapers, my friend, and I was out buying stocks. Yes, Tutomi, that is right. 1987. That is the year I graduated from my undergrad. So at that time, I was buying Fidelity Magellan. Michael, that is a great move, and hopefully you are one of the ones who basically held on to it and didn't try to trade it going back and forth when things got a little turmoil in the market, because Fidelity Magellan did a very nice job for investors during that time. Russ says he was in fourth grade in 87. Did you buy in October of 87? And I didn't buy individual stocks in October of 87, but I did buy into a mutual fund in October, which is what they call Black Monday, right? October the 19th, I think it was, 1987 was Black Monday. The market crashed, and what did I have to lose, right? I mean, I was how old was I? 22. I just turned 22 at the time, and what did I have to lose? So throw some money into a mutual fund. I didn't have much money, so it was a small number. So, guys, I get it. I get that there's, if you're just starting out, I get it. There's some small dollars to play with. But, at some point, it's going to turn into bigger dollars. So just stay the course and don't get distracted. I got distracted along the way. And so one of the messages I want to convey to you is don't get distracted. Don't pull that money out. Leave it in there. Doesn't matter how much you need a new car, which is what my issue was. Leave that money in there. Find a different way to get that new car. So anyway, for that's worth a drink. So Michael says, that guy that watered the flowers and trimmed the weeds was in charge of something, but that's probably right. Oh, Jim says, yeah, I remember Dean Witter. My broker was with Dean Witter. They always seemed to be bothered that I just wanted to buy my 5 shares of CAG so I could enroll in the company's drip. Absolutely, man. They didn't want to see us, young kids coming in with our $100 or whatever. Ex-dividend dad says he still owns AT&T. That's great. Hopefully that works out well for you. And yeah, Michael Swami says his broker is E.F. Hutton, and E.F. Hutton says, so those of you who aren't our age probably don't get that, but it was a series of commercials that talked about brokerage firms, and E.F. Hutton's commercial was, that everybody wanted to hear what E.F. Hutton was doing. So when somebody said, my broker is E.F. Hutton, and E.F. Hutton says, and all the noise in the room would die down, everybody be listening for what E.F. Hutton said. So those of you who are too young to know that, that's what went on. Yeah, shaping. That's right. No internet is crazy. And yeah, a lot of you guys don't understand that we didn't have access. We didn't have YouTube. Can you believe that? There was no YouTube videos, man. How did we learn to do anything? How did I learn to grow chickens or to raise bees without YouTube? So anyway, Jim says he was 31 in 87 and still in diapers. You're still in diapers now, or maybe you were then. I'm not really sure. Tutomi's first stock was Snowflake before I knew anything about dividend investing. Let's see. Anything else? Back in the day, yeah, we could talk about this, walking uphill both ways in the snow, going to school and stuff. But back in the day, we answered the phone without knowing who was calling. We were wild people. Yeah, the phone would ring, and we didn't know who was on the other end. It didn't have a display. There was no digital anything. It was all analog. So the phone would ring, and we would say hello. And if it was somebody we wanted to talk to, that's great. And if it wasn't, we still had to talk anyway. So Michael Swami was 26 in 87 and will soon be in diapers. It is funny how we kind of start this world with no hair and in diapers and no teeth. And we end our lives with no hair, no teeth, and in diapers again. It's really wild. So postage stamp licking investor for years. Yes, sir. That's right. So so anyway, guys, it has been a great program. I really appreciate all of you guys joining and being a part of this. So I love it. I love you guys. I look forward to this every week. I appreciate you letting me get a little bit of extra time tonight and going to that dinner. So that was fun. We had a great time. And so with that, I'm going to get out of your hair, and I'm thinking about doing a couple of videos this week. I haven't done an actual edited video in a few weeks. So I think I'm going to do some stuff for you guys this week on some different stocks. So look forward to that. And I will see you guys on the next one.